Welcome to the deep dive. Today we are wrestling with a number so large it almost defies comprehension. $344 billion. That is the staggering cash and T-bill reserve held by Warren Buffett's empire, Berkshire Hathaway, as of the second quarter of 2025.
Just an incredible figure.
This cash pile is not just big, it's historic. To put it into context for you, this single reserve is larger than the combined cash held by tech giants like Apple, Microsoft, Amazon, Alphabet, and NVIDIA.
Right, the big names.
Even though those companies collectively boast 14 times Berkshire's market value,
Yeah.
we are talking about an unprecedented war chest in modern corporate history.
And that scale, well, it requires an equally deep analysis, doesn't it? Our mission today is simple. We are going to stop gawking at the sheer size of the money.
Yeah, enough cog.
And start understanding the strategy that governs it. Is this $344 billion a sign that Warren Buffett is nervous or, fearful about the market?
Or is it something else entirely?
Or is it the ultimate, highly disciplined strategy designed to capture outlier opportunities? We will unpack his core philosophy, what he terms the 3 pillars of price, patience, and optionality, so you can apply these principles to your own decision-making, regardless of, well, your personal balance sheet size.
Because these financial concepts can be dense, we are applying the Feynman technique today.
Good idea.
That means we're going to break down every mechanism, from T-bills to float to gap accounting, into its simplest, most understandable components. We'll use concrete analogies to make the concept stick, ensuring you walk away not just knowledgeable about the strategy, but truly informed on the underlying mechanics.
Yeah, the goal is clarity.
Our goal is to cut through the constant market noise and focus on the bedrock principles that drive long-term value creation.
And the core idea, which is often lost in translation, I think, is that Buffett's strategy is not some complicated market timing scheme. It is pure price discipline.
Price discipline. Okay.
For decades, he has emphasized the singular goal: buying wonderful businesses at sensible prices. The sheer volume of cash simply reflects the reality that the market right now is demanding what our sources describe as palace prices for virtually every wonderful business available.
Palace prices. I like that.
Yeah. If the price isn't sensible, he doesn't compromise his standards. In this context, waiting is the most active and strategic choice he can make.
Let's start by building the foundation then. The record cash position is rooted in those 3 foundational pillars: price, patience, and optionality. These 3 concepts define Berkshire's capital allocation strategy. Let's unpack them, starting with the most restrictive element: price.
Price discipline is absolutely paramount, and its strict application is directly related to Berkshire's sheer size. I mean, when you are a trillion-dollar enterprise, you can't just buy a $100 million company. It's statistically irrelevant.
Right, it wouldn't move the needle.
Exactly. Any acquisition has to be what they call an elephant, meaning it must be a massive company that genuinely moves the financial needle for the whole corporation.
And the constraint here is twofold, right?
Yeah.
Not only are there fewer elephants out there, but even a slight overpayment on a deal of that scale, say paying 10% too much on a $50 billion deal, destroys billions in shareholder value instantly.
Precisely. If capital managers feel forced to deploy money just to look busy or, satisfy market expectations, they almost inevitably end up overpaying and eroding long-term value.
You see that a lot.
Buffett has famously said that he views the calendar as irrelevant. If there are no opportunities, the price is what matters most. He won't force an investment simply because the quarter is ending. This is the difference between investing and, well, speculating.
That brings up the perfect analogy, I think. Imagine you are trying to buy high-end artwork, but the entire gallery is priced at auction record levels. You admire the work, you have the money, but your standard for value tells you to walk away from 5 great pieces in a row. You maintain your standard, even if you're frustrated by the lack of opportunities.
Right. That's exactly Berkshire's current posture, but on a vast trillion-dollar scale.
So that patience, that walking away, is only possible because of the second pillar.
Yes, being paid to wait. That $344 billion is highly strategic. It was primarily held in short-term U.S. Treasuries, often referred to as T-bills. And this is where we really need to apply that Feynman technique, break it down.
Okay, let's simplify the T-bill mechanism for the listener, going beyond just calling it safe cash. Why are T-bills the specific parking lot of choice for this kind of strategic capital? What makes them special?
Well, T-bills are short-term debt issued by the U.S. government, typically maturing in a year or less. They are considered near zero credit risk because, they are backed by the full faith and credit of the U.S. government. That's the safety part.
Okay, safe. Got it.
But the critical distinction is liquidity and yield. Unlike holding literal cash, like stacks of bills under the mattress.
Which earns nothing.
Exactly. T-bills are currently paying a respectable interest rate thanks to the recent high-rate environment.
So if rates are, say, at 5%, that $344 billion war chest is generating about $17 billion annually in pretty much risk-free income.
Exactly right. Berkshire is literally collecting billions annually for the privilege of staying picky. The cash is not idle. It's a cash-flowing holding pattern. It serves as a financial bridge, really, allowing them to remain instantly liquid while earning real income.
And that income makes waiting easier.
It significantly softens the impact of holding cash while the stock market climbs, making the wait economically viable. It's not just dead money.
Which flows perfectly into the third pillar, optionality. This is where the cash transforms from a conservative holding into an aggressive weapon. I want to challenge this, though. Isn't relying on a financial crisis or distress an inherently, cynical strategy?
I wouldn't call it cynical. It's recognizing historical probability. Liquidity is a competitive advantage because panics are, inevitable, not theoretical. They happen.
History backs that up.
Sellers occasionally get distressed, and wonderful businesses go on fire sale prices. Having a war chest this massive allows Berkshire to act in hours, not quarters. They don't need to arrange debt financing, seek shareholder approval, or scramble for capital.
They just write the check.
They can simply wire the money, winning deals, and securing extremely favorable terms that competitors who are often suffering their own liquidity issues or scrambling for financing simply cannot match.
You're describing the difference between being ready for the storm and being caught in it. It reminds me of that firehouse analogy in the source material.
Yeah, that's a good one.
Berkshire is the firehouse with immediate, overwhelming water pressure on tap, ready to fight the fire instantly, while competitors are still waiting for the rain or trying to hook up to a distant hydrant. That speed buys them extraordinary terms.
That ability to exploit panic is the highest form of optionality. But this naturally leads us right to the listener's most pressing concern about this strategy, I think.
Right. Knowledge gap 1, call out. We've defined the strategy, but we must address the constant criticism. Cash drag. This is the risk of missing out on massive upside when the market is roaring. How does Berkshire justify sitting on $344 billion, knowing that historically, short-term cash holdings often trail a raging bull market?
It's a fair question.
And how do we reconcile that with their phenomenal long-term outperformance? This is the core psychological challenge of discipline, isn't it? We must address the statistical reality of that lag and the historical justification in detail.
It is the single most common reason why other fund managers, frankly, can't copy Buffett. They lack the psychological resilience to endure short-term underperformance.
The pressure is immense.
We will tackle the exact mechanics of that justification when we look at market cycles in Section 4. But for now, let's look at the concrete evidence that optionality pays off when the opportunity finally arrives. Okay, to really appreciate the power of optionality, we have to look back at a time when capital was the scarcest commodity, the 2008 financial crisis.
Oh, yeah. Real test.
This event provided the ultimate canvas for Berkshire's strategy.
Capital dried up globally, trust just collapsed, and strong institutions were teetering. Berkshire, thanks to its operational strength and, crucially, that liquid war chest, was ready to play offense when everyone else was paralyzed.
Absolutely. They provided crucial strategic funding to distressed but fundamentally strong American companies. Take the deals with Goldman Sachs and Bank of America. It wasn't just a friendly bailout. It was a highly profitable, structured investment.
Very structured.
In the Goldman deal, for example, Berkshire received $5 billion in preferred stock, paying a staggering 10% annual dividend.
10%. In that environment.
10%. And on top of that, they received warrants to buy billions more in common stock at a later date, essentially locking in huge upside potential for years to come.
That 10% dividend during a time of crisis is extraordinary. It showcases the absolute power of liquidity. They were able to generate enormous secure returns, almost like a private equity arrangement, simply by being the only player with cash and credibility instantly available.
Exactly. This showcases the power of liquidity as an offensive weapon. Berkshire didn't need to borrow. They generated cash from operations and were prepared for economic paralysis. That ability to structure non-dilutive, high-interest deals in hours, not weeks, demonstrates the direct, tangible benefit of holding that massive cash reserve.
Okay, so that's the triumph. But we need to balance the triumphs with the stark reality that capital allocation, even at this level, is prone to human error. We have to look at the Kraft Heinz write-down.
Yeah, that's important context.
In the Q2 2025 earnings release, Berkshire recorded a significant write-down on this investment.
This was a clear, painful acknowledgement that they had overpaid. Berkshire recorded a pre-tax impairment loss of approximately $5.0 billion, leading to an after-tax loss of $3.76 billion.
Wow.
While the formal accounting requirement was triggered by Kraft Heinz's announcement of potential strategic transactions, the underlying reality was that the carrying value of the asset on Berkshire's books was simply higher than its true market value. They paid too much.
That seems like a strange concept, though. If a business is supposed to be wonderful, shouldn't time be its friend? Why did this particular mistake prove so costly? What went wrong?
Well, it goes back to lesson one, price discipline. Even a good business can be a bad investment if you pay too much for it.
Price is everything.
And Kraft Heinz, due to its structure and maybe some operational challenges post-merger, was arguably not a truly wonderful business in the classic Buffett sense, or at least the price paid was far too optimistic. The lesson this write-down reinforces is critical. Capital allocation can go wrong, even for the experts.
So acknowledge it and move on.
The key is to acknowledge the mistake transparently, take the loss, and move on without letting sunk costs influence future decisions. Don't throw good money after bad.
And if we talk about acknowledging mistakes, we have to look at the very genesis of the company itself, Berkshire Hathaway. That started as a mistake, didn't it?
That's absolutely right. When Buffett first gained control, it was a cheap northern textile operation, a fundamentally failing business. Buffett's own calculations showed the company was essentially worthless as a textile operation, a mistake he chased for 2 decades.
A mistake he admitted years later was an emotional, poor decision, noting the business was structurally headed for extinction. Just a bad business.
A bad business. But the genius wasn't in trying to save the failing mill. That wasn't it. The genius was in the ruthless allocation of the cash that the failing textile business was generating.
Using the cash flow.
Buffett allocated that cash out of textiles and into better, stronger businesses, famously beginning with the acquisition of Geico. This decision to pivot rather than force reinvestment into a subpar operation is perhaps the greatest capital allocation lesson of all time.
Stop feeding the loser, feed the winner.
It proves his mantra. Time is the friend of a wonderful business, the enemy of the mediocre. It forces us to ask ourselves, right, are we holding on to a mediocre investment out of hope? Or are we allocating our resources to the true, wonderful businesses that deserve patience?
That distinction, identifying the engine that is worth allocating capital to, perfectly sets the stage for our deep dive into Berkshire's current operational foundation. Let's look at the Q2 2025 financial data and how they actually generate all this investment capital.
Right. The ability to field a $344 billion cash war chest depends entirely on the stability of the business engine backing it, and that engine is primarily insurance. This brings us back to the concept of float, which is, well, it's foundational to understanding Berkshire.
Okay, let's dedicate significant time here to ensure we nail the explanation of float using our simplification technique. What is float exactly, and why is it so special for Berkshire? Break it down for us.
Okay. Float is simply the difference between the premium money customers pay today for an insurance policy and the money paid out later to satisfy claims. The insurance company holds that premium, the float, until the claim is actually due.
So it's money held temporarily.
Right. For most insurance companies, this is just a liability on the books. But for Berkshire, because of their scale and discipline, it's a massive investment asset. As of June 30, 2025, BRK's float was approximately $174 billion.
$174 billion.
A $3 billion increase just since year-end 2024.
Okay, so $174 billion in capital.
Yeah.
That is essentially not theirs, but which they get to invest for potentially a very long period of time. But why is it considered free money, or at least extremely cheap money, for Berkshire specifically? What's the trick?
Well, the trick is operational excellence. Berkshire's core insurance operations consistently achieve what is known as an underwriting profit. This means that the premiums they collect actually exceed the total amount of claims and operating expenses paid out.
Which is unusual in insurance.
For the industry, achieving an underwriting profit consistently is rare. Insurance is often a commodity business, and competition is incredibly fierce, driving down margins.
And we have the specific data for one of their key segments, GICO, in Q2 2025, right?
Yes, a great example. GICO had a combined ratio of 83.5% in Q2 2025. Now, the combined ratio measures total claims and expenses divided by total premiums. A ratio below 100% means you made an underwriting profit.
And 83.5% is way below 100.
Exactly. An 83.5% ratio means they earned a profit of 16.5 cents on every premium dollar before they even factor in the investment income generated by investing that massive float.
That is immense operational excellence. They're literally being paid 16.5 cents on the dollar just to hold and invest $174 billion of someone else's money. This is why the cash word is sustainable and why they have the permission to play offense. The capital base is virtually interest-free or even better than free sometimes.
Absolutely. Now, let's move from float to the overall health of the business, which brings up a confusing point in the Q2 2025 financial report. The headline numbers showed net earnings attributable to shareholders were $12.37 billion, down dramatically from $30.34 billion in Q2 2024.
Yeah, that looks like a massive collapse, almost a 60% drop.
It does. That is a headline number that would scare most retail investors away, wouldn't it?
Definitely. So what is the key to reading this signal correctly? How do we simplify this?
We must remember the complexities of GAAP generally accepted accounting principles. GAAP requires publicly traded companies to include the changes in unrealized gains or losses of their equity security investments in their net earnings calculation.
Unrealized, meaning paper gains or losses.
Exactly. Since market valuations fluctuate wildly quarter to quarter, the net earnings number becomes extremely volatile and, as Berkshire explicitly warns in their own reports, extremely misleading.
So if the market value of Apple stock goes up by $10 billion this quarter, that profit is booked in net earnings, even if Berkshire hasn't sold a single share. And if the market value drops by $10 billion the next quarter, it's booked as a loss, even though nothing fundamentally changed in their operations.
Precisely. Think of it this way. Net earnings is like tracking the fluctuating paper value of your house based on what your neighbor's house sold for last week. It changes constantly. Operating earnings, however, is the actual income you earn from your job or perhaps a rental property you own.
The real cash flow.
That is the figure we must focus on. The true underlying profitability of the businesses Berkshire actually controls and runs day to day.
Okay, so what did the operating earnings show for Q2 2025? What's the real story?
Operating earnings were $11.16 billion, which was a modest 4% decline year over year. Not great, but not the catastrophe the net earnings number suggested.
Okay, a small dip.
But if we dig even deeper and exclude the noisy insurance underwriting results and the other segments, which included volatile things like large foreign currency exchange losses related to non-US dollar debt.
So strip out the volatile bits.
The core manufacturing, service, and retailing businesses actually grew their operating earnings by a very respectable 13%.
Okay. That is the real signal of health then. The businesses they actually control are getting more productive and more profitable. Can you give us a specific example of that operational strength within the portfolio?
Sure. The BNSF Railroad is a perfect example. While facing some challenges like lower volumes, BNSF saw its operating earnings rise approximately 19% compared to the same quarter last year.
19%. How?
Driven not primarily by higher prices, but by significant productivity improvements in logistics and scheduling. Better operations. This shows capital allocation isn't just about buying new companies, it's about relentlessly optimizing the giants you already own.
Okay, so the operational engine is strong, the float is providing effectively free capital, and they have $344 billion ready to go. But let's look at how they deploy capital internally. They have the ability to repurchase their own shares, Berkshire stock, but they haven't done so recently. What does that signal?
It signals the relentless application of that price-first discipline, even on themselves. Berkshire has not repurchased stock for the last 5 quarters, which is an unusually long period for them recently.
5 quarters, wow.
They only buy back shares when the price is clearly below their calculation of intrinsic value. The market price for Berkshire stock has been elevated, with the price-to-book (PB) ratio nearing 1.8 times book value back in May 2025.
Okay, for the listener, what exactly does a PB of 1.8 mean in simple terms? And why is that too high for Buffett?
Right. PB compares the current stock price to the accounting value of the company's assets minus its liabilities, basically its net worth on paper, book value. A ratio of 1.8 means investors are willing to pay $1.80 for every $1 of stated net asset value.
So an 80% premium over the book value.
Exactly. While Berkshire has historically traded above 1.0 because its businesses are worth more than just their book assets, Buffett's stated threshold for comfortable buybacks is usually closer to, say, 1.2 or maybe 1.4 times book value.
Or slower.
By stopping buybacks for over a year, he is communicating clearly to the market that even he views his own company's stock as too expensive relative to his internal measure of intrinsic value. The discipline is total. Price is everything. So the current state of Berkshire is defined by high operational quality and, unparalleled financial readiness. The sheer size of the cash hoard, combined with the lack of buybacks, leads us inevitably to the future implications. When will this capital be deployed? And the primary determinant seems to be the broader market backdrop.
And the backdrop, based on our sources, suggests the market is currently priced for perfection. Maybe even beyond perfection. Give us the data point that screams expensive.
Well, a key one we look at is the S&P 500 price-to-earnings PE ratio. It currently sits at around 30.
30.
To put that in historical perspective, the long-term historical median PE ratio, going back decades, is around 17.9.
So 30 versus about 18.
Right. Trading at 30 means we are 67% above the historical average. That's a significant premium.
A PE of 30 means investors are paying $30 for every dollar of corporate earnings. That kind of deviation suggests we are in a period driven more by investor enthusiasm and optimism, or greed, as Buffett might label it, than by underlying corporate earnings growth. Is that fair?
I think that's exactly right. This valuation level is historically quite high, often signaling caution. We saw similar highs immediately preceding the 1987 crash, and again in 1999-2000 during the tech bubble. This is precisely the condition that encourages Buffett to hold cash. He is waiting until those valuations normalize, or perhaps until a crisis throws a market correction his way, creating those sensible prices.
This brings us back full circle to knowledge gap 1, cash drag. How does he justify missing out on the massive upside that occurred, for instance, in the late 1990s or during some of these recent AI-driven rallies? What is the reconciliation for sitting out those parties?
The reconciliation is actually pretty simple, conceptually at least. The cash hoard is the protection against forced errors during the market's manic phase, and it's the guarantee of massive returns when the inevitable panic phase hits.
Play defense during the mania, offense during the panic.
Exactly. Think back to the late 1990s. The S&P 500 was roaring based on speculative tech valuations. Berkshire was widely criticized for holding massive cash reserves and for underperforming the index significantly for a few years.
They looked completely out of touch, like they were missing the boat entirely. People were calling Buffett washed up.
They absolutely did. But when the tech bubble burst between 2000 and 2002 and valuations crashed, Berkshire's cash suddenly became tremendously valuable. While the rest of the market was hemorrhaging value, Berkshire was able to deploy capital at steeply discounted prices in the subsequent years, driving its long-term performance far ahead of the index over the full cycle.
So they accept the short-term pain.
They accept short-term lag as the necessary price of discipline, knowing that their long-term outperformance is secured not by participating in bubbles, but by avoiding the inevitable crash and utilizing the cash when others cannot. It takes incredible patience.
That is the ultimate justification. The willingness to look wrong, sometimes for years, to ensure they are right over decades. However, the constraints of scale are real today. The sheer size of the $344 billion is actually a problem in itself, isn't it?
It really is. It creates significant regulatory and logistical bottlenecks that a smaller investor simply doesn't face. First, as we mentioned, there are fewer and fewer targets big enough to buy outright that don't already have exorbitant prices. The elephant pond is small.
Right.
Second, any full acquisition worth moving the needle for Berkshire, say something in the $50 billion or $100 billion range, faces immediate and intense antitrust scrutiny from regulators, both in the U.S. and internationally.
So even if the deal is fairly priced and makes strategic sense, regulators can block it or just delay it for years.
Right. And the threat of this blockage forces Berkshire toward maybe smaller minority stakes or structured financing deals like the Goldman one, rather than full takeovers, which in turn keeps the cash high for longer.
So the cash can't be deployed easily because the market is too expensive and the regulatory environment is too restrictive for deals of their necessary size. It's a double bind.
It kind of is. This is why the cash hoard remains a defensive fortress until, perhaps, a crisis changes the rules of engagement or resets valuations dramatically.
And we can't ignore the context of succession here. While Buffett stated he wouldn't hoard cash just to make his successor, Greg Abel, look good. Well, that massive reserve certainly provides unparalleled flexibility for the transition.
It absolutely does. It offers maximum stability and flexibility for the next leadership team. If a market correction or a financial crisis were to occur shortly after the transition, Greg Abel would have a clean slate and the immediate capacity to act opportunistically, ensuring a smooth continuation of the culture of optionality. It's a huge asset for him.
Okay, we've covered the primary risk of cash drag by providing that historical context. Let's briefly address the other key financial risk associated with holding so much cash or cash equivalents, rate risk.
Yes, rate risk is very real. If the Federal Reserve or global central banks were to suddenly drop short-term interest rates quickly, the income generated by those $344 billion in T-bills would shrink dramatically.
That $17 billion a year could become much smaller.
Exactly. This would raise the opportunity cost of waiting. It puts pressure on management to deploy the cash before it starts to truly drag down overall returns compared to other options. This is why the management team must constantly reevaluate, re-underwrite the cost of holding versus deploying capital based on the macro interest rate environment. It's not a static decision.
This brings the complex decision-making back down to the individual level, because obviously we can't perfectly copy Berkshire's balance sheet, but maybe we can copy the process.
I think that's the key. And it leads to another important gap for individuals. Knowledge gap 2. Call out. Since the long-term trend of the market is inevitably up, as Buffett himself always notes, what is the optimal threshold for an individual investor to maintain as dry powder cash or T-bills before the risk of inflation eating it away or cash drag outweighs the benefit of having that optionality?
Right? Is it 5% of your portfolio?
Yeah.
10%, 20%? It's different for everyone.
That is a constantly moving calculation the individual must make based on their own goals and risk tolerance that Berkshire's enormous scale kind of simplifies for them, ironically.
So if we strip away the billions, what does this disciplined process mean for you, the individual investor listening right now? What are the practical takeaways?
You copy the process, not the size. First, maintain an investment standard. Be absolutely clear on the quality of business you want to own and, crucially, the price you are willing to pay for it. Don't compromise on price just to be invested.
Define your sensible price.
Yes. Second, get paid to wait. If interest rates allow, keep your dry powder, your emergency fund, or your opportunity money in instruments that actually earn a reasonable return. Whether that's high-yield savings accounts or short-term treasuries, don't let it just sit there losing to inflation if you can help it.
Make the waiting productive.
And third, separate patience from paralysis. Waiting is an active choice based on price when nothing meets your standard. It shouldn't become a passive habit just because you're afraid to make decisions. Know why you're waiting.
That sounds intellectually sound, but we know the hardest part is the psychological endurance. It is relatively easy to stick to your standard when the market is down or flat, but it's agonizing when the market is roaring past you and your cash isn't participating.
Absolutely.
That leads us to our final and perhaps most profound, deeply psychological knowledge gap for the listener.
Knowledge gap 3. Call out. The data shows BRK underperformed the S&P 500 roughly 1/3 of all calendar years and about 28% of the time even over rolling 3-year periods. That's significant underperformance, sometimes for long stretches. For an individual investor, how can one manage the psychological difficulty, which often translates into the fear of losing clients or even firing risk for professional fund managers, of holding on to a long-term discipline when short-term performance lags, sometimes dramatically, for years at a time?
It is so easy to call yourself a value investor until the market rallies 20% in a year while your carefully held cash sits there earning 5%. The ability to endure that lag, knowing your valuation framework is correct even when the market passionately disagrees for a long time, requires an inner confidence, a temperament, that is perhaps the single hardest component of the Buffett strategy to truly master.
It really requires behaving in what Buffett himself calls a very irregular manner compared to the systematic requirements and pressures of most investment managers. Most managers are mandated to stay fully invested or close to it. Buffett made a lot of his fortune by being willing to sit still, look inactive, even look wrong, while waiting patiently for everyone else to make a mistake driven by fear or greed. #tag outro. So, to summarize our deep dive into the source material today, Berkshire Hathaway's $344 billion cash hoard is definitively not a sign of fear or hesitation. It is the ultimate expression of readiness and price discipline, supported by a fortress balance sheet and that incredible engine of essentially interest-free insurance float. It's strategic patience.
The ultimate lesson for you, the listener, maybe isn't about billions of dollars at all. It's realizing that true long-term outperformance often requires the willingness to sit still, looking utterly inactive, sometimes even foolish, while the rest of the world is busy doing something dumb. So the question becomes, what irregular behavior do you need to adopt in your own investing life to maintain your standards and secure your optionality, even when everyone else is shouting about the next great rally?
That is the pivotal question, isn't it? Valuation and temperament. Thank you for diving deep with us today.
We'll catch you next time for another deep dive into the sources.